Okay, let's do this. I got that to open and it looked fine. So we will just roll with this. Let me do the intro again real quick. And
Yeah. No, go for it. It's fine.
all right, so hello, everybody. My name is Ansel Lindner. Welcome to a new podcast. We're calling Bitcoin Global. We're not 100% on the name yet, but we like this title because we're going to be talking more about the macro situation, negative interest rates, how the trade wars affect different economies, emerging markets, as well as, of course, U.S. and Europe and things like that. Just do kind of deep dives on these things and talk from not a layman's perspective, but we are not professionals. Anyway, my name is Ansel, and I am joined by my co-host, Kent. Do you want to say hello?
Hello, everyone.
So today we are just going to talk about negative interest rates and maybe a couple other things and see where our tangents go. Kent, did you want to introduce the article or whatever we're talking about here?
Sure. Basically, we've got kind of a topic, which is negative interest rates, and then we've kind of got an example of the deployment of negative interest rates. Looks like primarily in Europe. The first article we have here, and I'll read the title, is from Market Watch. This was posted on the 22nd of August, so just 5 days ago. And the title is "That Near $17 trillion Pile of Negative Yielding Global Debt. It's a cash cow for some investors." How are they going to pull this off, Ansel? How are they going to issue these bonds, or continue to issue these bonds at negative yields?
Well, they have to push them more negative, or I don't know, inflate them away. They print more money to backstop these banks. But what exactly are negative rates? Should we define that for the listener?
Yeah. So basically, the way negative interest rates work is you have a bank kind of in the middle. On one side, you have the depositors. They may open a savings account or whatever. And then on the other end, the bank, in order to make money, has to make loans or lend to people for investment purposes. Basically, what this creates is something called a float. A float is the difference between what a bank pays the depositor, which is nothing, it just takes in this case, versus what the bank basically has to lend out at a higher rate than what they pay their depositors. So I know it gets a little confusing, but the same rules kind of apply. So in essence, the rate that the depositors have to be getting charged a steeper negative rate in order for the bank to loan out at I guess what we'd say a higher negative rate. So hopefully I explained that well, but yeah, I think that's the best explanation I can give. I think when we go into the situation in Denmark a little bit in a little more depth, that should probably help the listeners some.
All right, so that's how you keep the rates negative. But as just a general definition, negative rates are when you get paid to borrow money versus you having to pay someone else to borrow money. It's backwards of everything you've ever thought about a loan or borrowing money. But yeah, to your points there, the bank has to turn a profit, and so they charge more interest from the loans that they give. But to the depositors, where they get the money or where they're supposed to get the money, they give them less of an interest rate. So then they get the difference.
Right. The depositors are basically paying a fee to park their money. Well, I think that's probably easier. They're paying a fee to park their money at the bank, and the fee that they're being charged is greater than the negative fee. So basically, in essence, if you work your way backwards, if you start at the borrower, then you work your way to the bank, and then you work your way from the bank to the depositor. Starting with the borrower is in essence charging the bank uh, the what was it 0.5% interest, and then the bank is charging the depositor 0.6% interest. Yeah, that would be correct. I know it's a little confusing, but that's probably the best way to explain it. And that difference there, that 0.1 is
So yeah, so I think that you described what they are and how they're kind of possible.
right. But this gets me thinking, because if you remember a couple years back, I don't remember what year it was specifically, but Sarkozy, the former was it president, prime minister, I believe prime minister of France,
Yeah.
he uh, he he kind of ran on. He's a socialist, and he ran on a platform of, if you have kind of this amount of money, I think he set the threshold at like €1 million. In the banking system, you're going to get these excessive taxes levied on you. And so, long story short, apparently Putin opened the door and said, we'll give you much better rates here in Moscow. So there was capital flight,
I remember
and
that. I
obviously,
remember that. That was a really good move by Russia.
right, right. It's an excellent move, and in just even if they didn't want to go there, there's plenty of places that were offering better. They're treating, what do they say? Capital goes where it's treated best.
Right.
And so there's plenty of opportunities, probably even inside the EU, where they could go and get a better shake than what they were dealing with in France. And so
Well, yeah,
in that,
the pigs.
oh,
They
go ahead.
could go to the pigs.
Yeah, well, because their interest rates were and are higher than they are in France, right?
Yeah.
Okay. Yeah, I'm more familiar with the rates of their sovereign bonds. I'm not as familiar with their bank rates. I know they're intertwined, but what was I going to say? In the same vein, with these Danish banks, going deeply, doing this not deeply negative. I mean, they're just scratching the surface. But the threshold is, so if you have 1.1 million euro in the Danish bank or more, you get charged these negative, these, we'll just say you're getting charged by the bank 0.6% on your savings to park your money at the bank. And to me, now, I mean, this is still far off from the amount of taxation that the French government was basically going to confiscate from people of that certain threshold. But I mean, it's awfully similar, isn't it? 1 million, 1.1 million, So,
Yeah.
um,
Yeah. But that it's a different climate today because rates are lower everywhere than they were 2 years ago. So I think that there would be maybe less capital flight, but I don't know. There probably will still be some, and it will chase people into Bitcoin and gold and so forth. But how do they keep it? See, I always think like, how do they keep it low? Because there's so many bad consequences of negative interest rates, and but they keep going further and further negative. I always think it's like a greater fool theory, and that so somebody buys this at negative 0.5% because they think somebody else is going to buy it from them at negative 0.6%. So there's always seems to be some sort of greater fool. And the bad part about this is that the central banks, they they always say that they're the lenders of last resort. Well, now they're the borrowers of last resort, and they're also the greater fools of last resort. So they will always buy up something to keep the initial investor solvent. What do you think about that idea?
I kind of wonder, and with these, so being that Denmark has such high rates of taxation, I just have, and it's not like anything new there. Like that's been the case for many many years. They have a history of that. So I'm just kind of like thinking to myself, how many Danish people, I know there's not many, are keeping 1.1 million or more of their funds, in Danish banks. One, if you're making that type of money or more, like it would just, to me, it would seem that they would probably park most of their assets, or they do something to shift their capital out of the country. Um, so I don't know. Part of me is like, well, what if the ECB is maintaining like a whole series of deposits that are I guess over that threshold, that 1.1 million. It's like greater than that, and they're the ones that are actually propping up this system.
I
I mean,
I just looked it up. There's 70,000 Danes who are millionaires in US dollar terms. So that's not euro terms or kroner terms or whatever, but it is US dollar terms. So maybe over 50,000 Danes, but that's still not that many.
no, certainly not. That's a very small number, and yeah, so I haven't looked at the banks. I don't know what the magnitude of the loans that are being lended out are. Those number, because this is so new. I don't think we'll get some of those numbers for a while, but it'll be very interesting to see how this plays out. And you know, I don't know. That's
You remember Iceland when they had their big banking crisis? They only have 200, I think, and 50,000 citizens at all. But they had a big, like they ran the bankers out, basically, had a gigantic crash in their economy. Um, I don't know if it was a 50% contraction or, I mean, it was something huge. But then within a matter of years, they had purged all of that and they were back doing well again. So I think these central banks and these governments make it worse because, well, first off, they don't want to be run out. They don't want to be tar and feathered, right? But I think that's coming again. Bankers are going to be tarred and feathered because, I mean, this just is leaching value and capital out of the economy.
right there. It's a massively redistributionist wealth scheme that is basically siphoning any little bits of excess wealth. I hesitate to call it wealth because in a lot of these places you have gigantic gaps between those who have and those who don't. And so yeah, it's probably the greatest redistribution scheme that's ever existed on a global scale. So
Well, yeah, and it's more than that too because you can't do proper, like if you're bogged down by this debt that you cannot pay back, and all you're doing is you're driving rates down and you're printing money. Price discovery mechanism, like where new capital should go, is derailed. And so not only are they trying to confiscate this wealth, but they're keeping the market from correcting, right? They're totally destroying the capital allocation within their country. So that's a very bad scenario. And I mean, Europe is a really good case because they're so negative. Japan is another one, but it's all of these economies are destroying their capital stock and redistributing the financial wealth to the bankers.
right, and to your point, what's really important for the listeners to understand is that when these banks, for example, something like QE, which this is all in the same vein, when they print trillions upon trillions of fiat currency and they inject it into their own, what we'd say, they inject it along political whims, if you will. So like into the housing market, into the stock market, etc. What it does is it creates this sort of like it's I don't know if a tailwind's the right word or a vacuum, because what it does is it boosts these asset prices and it sends signals to the rest of the economy that, hey, this is the direction of growth. This is the direction that things are going. And so that's then other people that are not privy to those funds from the central banks, they throw their investments into those directions as well, and it's just creating a massive bubble. And it's just like you said, it's a misallocation of resources. It's what Mises called, malinvestment. And so that's the end result is just going to be pure devastation.
Yeah, the entire price structure of the economy gets manipulated,
Right.
and people can't make good decisions. Another thing too is like, let's say I wanted to start a business in a well-functioning capitalistic society or economy, in a market economy, and interest rates were, the lowest interest rate I personally could get for my startup business might be 9, 10, 12% something. And my idea is not that good, right? So I wouldn't borrow the money and I wouldn't start this new business because, it's not a good enough idea. And so people, when interest rates are zero or negative, they don't have that hurdle, right? The common sense hurdle to get over. And so people start a bunch of crap businesses. They distort the price structure in the economy even more than it would just with the central bank manipulating prices of capital.
Right. And well, ultimately, in the last couple of years, I believe the stock markets have continued to go higher. I know they've gotten kind of wobbly lately, but through these mechanisms that we're describing, negative interest rates is in the same vein as artificially low interest rates. And these banks and these companies have literally just gorged on corporate debt and things of that nature, and they've just pumped them into the stock markets. So they're actually not creating any new value. There's no hiring. There's no research and development. There's no productivity gains. They're just juicing asset prices. So the amount of malinvestment is just on a scale that's like I don't have words to describe.
It's unbelievable. Yeah, it's absolutely
Right.
unbelievable. Well, yeah, you said gorged. I thought of they're gorging themselves on empty calories, and they're getting fat and sick, and they don't understand. We just need to pump more calories into this system and get more productivity, but you can't do that. I mean, the market is trying to correct itself, and it's being stopped from doing that because of this extra money that's coming in. And like you said, I mean, the malinvestment in all of these Western economies, even Eastern economies, everybody we have no idea how bad it is. I remember I was saying on my other podcast that the Dow Jones, I think after 2009 was down at 6,000, but that was after being saved by TARP and by QE and all of these things. So we don't know where the real value is. We don't know what the real prices of anything are. For sure, when you look at the stock market, I guarantee you that's not fair market value for these things. So, that's all I got on that.
Yeah, no, it's good. The last thing, I don't want to get too off topic with this one, but one of the things you'll notice with the legacy market, if you, for example, you just watch the Dow Jones, what you'll notice is that I'll just use the China trade deal thing it's a joke, but it's been going on for a year and a half. And anytime Trump says we're talking again, or oh no, it just swings between positive Trump comment and negative Trump comment. And since there's no real actual people trading in the market, it's just algos, and I think they're built to basically respond to news. So if he says something positive, boom, it boosts the stock market. If he says something negative, they're just programmed to respond that way. It's just robotic. It's not real. It's completely artificial. But anyway, I digress. That's going into.
And there's the plunge protection team. So even if the algos were to run away to the downside, there would be circuit breakers. There would be the plunge protection team. Everything built in to keep the market from correcting to fair market value. So, and yeah, like we have been saying, it just compounds on itself. And the utter just look at the 22 trillion in debt for the U.S. That is straight up malinvestment. And so,
absolutely,
yeah. So that's a minimum. right? That's not even all the corporate debt and all this other stuff. Like that's a minimum of what we're holding back from the economy.
Right. If the debt keeps expanding, whether corporate or sovereign, if the debt keeps expanding, then you are you are an inherently bad investment. That is why the debt keeps expanding, because you can't pay it back. You have to keep rolling it over. And
Yeah.
so yeah,
Well, good.
I didn't want to go too much into into that per se, but
Well,
because
let's bring it back to the negative interest rates. So,
sure.
um, we talked kind of about what they are and how they're possible, but how do they keep going negative more and more? I mean, is there a limit to how negative they can go in your opinion?
This is going to be the interesting thing because a couple thoughts on this. First, I know with like the Greek crisis, bail-ins and bailouts and so forth, specifically bail-ins. Bail-ins are really they act in the same way as far as like depositors are concerned as negative interest rates, because they're getting these huge haircuts on their savings. And so I mean, I don't remember what I can't remember if it was between like 10 and 25% or something during the Greek crisis. You know, the
Yeah,
amount that they were
we just looked this up the other day. What was it?
oh, I can't it
God
escapes
dang.
me.
It was like $200,000 and you lost like 48% above that or something like that.
And yeah, and as you went down in terms of the amount of money you has deposited, I know that the rate that you lost went down too, but the point being, the reason I brought it up is that there was a threshold somewhere there where they were basically like, no, we're not going to get bilked for any more than this, because people were, they're yanking cash out, they were hiding it under their mattress, et cetera, et cetera. And so, I would say that these negative interest rates are not going to be able to go 10%. I mean, you start getting to those numbers and you're just going to see massive capital flight. And again, that's where Bitcoin's strong. That is exactly where Bitcoin's strong, because it's just waiting with open arms, for these types of situations. It's kind of built for that.
Yeah,
But
and that's if they keep the off ramps open. I call them off ramp, fiat off ramps, not Bitcoin on ramps, because
mhm.
Bitcoin doesn't care. It is the off ramp that is being regulated. So I can see that. But gold has also been catching a bid here. So I don't think gold is done quite yet. I mean, I'm one of the biggest Bitcoin bulls out there. And I think Bitcoin will surpass gold's market cap within probably 5 years from now. But gold still has a role to play here. What do you think about gold and silver?
So silver's more of an enigma. I hear all these different things. I truthfully don't follow it that closely anymore. I mean, it got demonetized, back in the latter part of the 19th century in favor of gold having the much lower stock to flow ratio. And part of me, and again, this I'm not overly qualified to speak on this, but is silver just a industrial metal at this point? I guess we
Yeah, it
had
is.
silver coins up until the '60s, but I don't know. What do you think? I think this is you probably have a little bit
Well,
more depth of knowledge on this specific topic.
well, yeah, like I'm my kind of biggest area of interest is money and monetization and even the history of monetization going back, hundreds of thousands of years almost. And yeah, I think that silver, well, if you just look at the last couple of days though, it's caught a pretty nice bid, up like 5% in the last couple of days. So it is it might have another hurrah as well, but yes, it is for the most part an industrial metal. The stock to flow ratio of silver is very bad. It's been eaten away by so many years of manipulation and all these things that the people actually ate into the stock for industrial uses. And now the stock to flow is much worse than it was even 20 years ago.
Yeah. Oh my goodness, you're right. It's since June 3rd, silver has just absolutely exploded. Um, it was at in USD. It was at I'm just on SD Bullion's website. it was at 1436 roughly. This is, I'm just using the chart, and it's goodness, it's at 1839. I mean, that's a that's a huge move in a very short amount of time.
Yeah, I used to look at the gold, Bitcoin gold ratio. We should do like silver Bitcoin and gold Bitcoin.
Definitely, definitely. So, did you have anything else you wanted to add on the silver gold topic?
No, I think that's good. Are we going to keep going on the negative interest rates?
Yeah, yeah. Just a couple more points. I wanted to. So, I was listening to the Kaiser report last week, and they had a show called .com Moment for Bonds. It's a good show. It was good. It was a good segment. And anyway, they're basically saying that in order to, we were talking a little bit ago about the ability of these countries to uh, maintain negative interest rates. And one of the interesting things is that in the EU, which is kind of the poster child for negative interest rates, again, Japan's in the fray, but it's the EU that's really, with Christine Lagarde and these different players are really pushing this. And on the Kaiser report, they said that the pension system in Europe is actually forced by law to invest in these sovereign bonds, which have negative yields. So that's a honeypot. I mean,
Ouch.
yeah, I mean, people can't do anything about that in a sense. I mean, they can get to take to the streets and riot, but as at least as of right now, the calm before the storm, that's they're just getting nailed. So if other people decide, well, we're just going to pull cash out, which is actually again really hard in Europe because they've really pushed hard to go cashless. Transactions are illegal, beyond a certain amount, etc. But anyway, I want to throw that out there and get your thoughts on that.
Yeah, well, that's what sucks. I mean, being a baby boomer, you have had at least 10 years now of really bad type of pension investing climate. And they're going to be hurting, especially if it is still all based on bonds or it's based on stocks and things like that. People are going to be really hurting. And I think that actually, like politically, that is a huge negative as well because the main people that vote are the older generations. I mean, the young people really only come out in like a 20% voter participation or something like that, where the old people come out 50 to 60%. So this could have bad political outcomes as well as people are hurting with their pensions. As I understand it, the way you want to do, like pensions want to have about 7% returns. And if they're not getting that in their traditional, whatever they're investing in traditionally, like sovereign bonds, say they might get 5% in the past and now they can't even get that. So they're going to riskier and riskier investments. And it's going to be bad, dude. It's going to blow up in their faces. And right when we have all these old folks needing to go into these assisted living places, they're going to be dirt poor. And what do we do? That's a hard question for society, I think.
Right. I mean, my own parents have my grandmother's still alive, and they have solid savings, but they're dollar denominated savings, and I've kind of been imploring them to explore at least a small amount of Bitcoin, and if they're not comfortable with that, at least pile into physical gold. And I wouldn't say it's fallen on deaf ears. I just think that old habits die hard, if you will, and getting them to transition into something that cannot be easily manipulated by political whims is challenging because they've kind of grown up in a very stable environment, if you will, and they can't picture a situation where the dollar implodes and you have a Weimar hyperinflation where you have people literally starving. I mean, that's within the last 100 years. That's not that long ago. So yeah, to your point, the that's what worries me the most is what is potentially coming. What are going to be the ramifications of this policy? I also wanted to point out on the pension, like in the United States, in the pension system, There's a huge corporate debt bubble. We can cover this in another show, but it's at the highest levels on record. And basically, a lot of these are zombie companies that are eventually going to get downgraded from triple B to junk. And what's interesting about that is that pensions are legally able to hold triple B bonds. But if those bonds slide into junk status, they are forced to sell. They cannot hold those on. So, I mean, you've got like trillions of dollars, I believe, in triple B that are basically they are insolvent. They're not able to meet their obligations, and they will slide into junk status, which in theory would force panic selling from the pensions, and the whole scheme would collapse. I mean,
Well,
something
why would the
else.
rating agencies do that then? I mean, we know that they're corrupt, and so wouldn't the
Mhm.
rating agencies just keep them rated at where they need to be, minimum?
Well, that's a good question. I mean, I know the rating agencies were basically gold stamping the mortgage-backed securities going into the 2008 financial crisis. Ostensibly they're probably getting paid by the banks to make these calls, but yeah, I mean, I can't think of any. I'm sure there's a bunch of attack vectors that even if they did that, that would there's just it's like you've got a ship and it's just got so many holes in it, and they're just trying desperately to put a hand on as many holes as possible. So I can't think off the top of my head of any other ways that the whole scheme would fall apart, even with the rating agencies complying, but I'm sure they're out there. Can you think of any?
Yeah,
Um,
it'll just until they can't ignore it, right? And in the 2007, 2008 timeframe, when people started defaulting on their mortgages, it came in at 0.5% and then 1%, and people weren't like all the investors on Wall Street still uh, didn't want to wake up. They thought, oh, this is just a blip because this can't happen. And so then all of a sudden it hit 5% and 10%. And then they panic sold. So I think that default rates will cut through the ratings agencies, but that's scary too, because that means you actually have to have the pain. Somebody is feeling that pain um, until people wake up.
right, and a lot of these corporations that are they're debt dependent, so they need these negative interest rates that we've been talking about. They desperately need them. It is their bloodline, and they've got legions of employees who have no idea what's going on at the top levels and how zombified these companies are. And if these companies cannot continue to take on debt, they're going to literally collapse, and all the jobs with them, which is just going to set off a domino effect, across the domestic and global economy. So,
Well,
uh,
what about Bitcoin? So let's tie this back to Bitcoin. Bitcoin, I recommend people investing a little bit in Bitcoin, but not like, well, I personally am pretty heavily invested, but not to the point where I feel uncomfortable, right? And so I think that everybody should get just a little bit of it because, yeah, it can't be um, inflated. It's never going to have a negative interest rate. I guarantee you that. When there is already Bitcoin lending, and it's really high. It's like I think it's 7% roughly that people are getting on their Bitcoin loans, and so I mean there is yield to be had here. There is of course price appreciation. Um, so yeah, if everybody just had tried to buy one Bitcoin for their pensions, and let's say you have $500,000 or $1 million in your pension or something, and um, well, yeah, I'm in your 401k. I guess pension is like yearly, right, or something like that. And so you have $500,000 saved up for your retirement. What does it harm to put 10,000 into Bitcoin? Probably nothing in the grand scheme of things, right?
well, yeah, I mean, and what separates Bitcoin is the fact that these gigantic banks are just basically, typing digits in a screen in the same way that we type whatever we want, on a document on the computer. With Bitcoin, you cannot just wish Bitcoin into existence like you can this filthy fiat money. Bitcoin has to be created through a very capital intensive mining process. It mimics gold. You've got to basically get capital. You have to have labor, you have to have time, and you have to go out and you have to actually dig up the stuff. It can't just be printed. So it's just like with farming, or planting a bunch of apple trees. It takes capital, it takes labor, and it takes time. So Bitcoin actually mimics the real world. These infinite zeros and ones and eights, or whatever it is that they decide to inject, quote unquote, inject into the economy, is just a falsehood, because it doesn't mimic the fact that we live in an environment of scarce resources.
Right, and you can't base a price structure off of a magic fiat money that you can just print and create whatever inflation that you want. So, all right, guys, that was episode 1 of Bitcoin Global. My name is Ansel. I was joined by my co-host, Kent. Next episode is going to be on the yield curve inversion. See you there.